Give me my silver immediately. Not in the morning, not next month, not once some funding round closes, right this second. The tension we're seeing in the silver market is the type that doesn't gently release. It breaks suddenly, and when it breaks, it shows no mercy to anyone clinging to a paper commitment. This is John A.G. speaking, and as I record this, it's Friday, January 23rd, 2026, precisely 8:29:18 a.m. Eastern Time. Drop a comment with the exact time you're viewing this. I want to track how widely and quickly this alert reaches people and sparks awareness. One fast note first. YouTube analytics reveal that a large portion of viewers on these clips aren't subscribed yet. If my content brings you insight, tap subscribe immediately. It's the simplest way to back the channel. Today, my plan is straightforward. I'll analyze the recent surge that ignited the silver chart, the worsening paper short buildup, and the physical stock situation that's becoming impossible to overlook. Then, I'll cover the tough reality. What if the paper manipulation holds out longer than the excited crowd anticipates? That's the exact mistake that wipes out many. Let's dive straight into the chart, because charts stay objective and ignore alibis. In recent trading sessions, silver hasn't merely crept up. It has surged forward aggressively. It smashed through former resistance zones with real force, triggering the usual dual responses. Retail buyers rushing in out of fear of missing out, and big players refusing to accept it. That's where the real action begins. As the price climbed, the typical reaction wasn't to back off and allow natural breathing room. Instead, it followed the familiar pattern. Flood the market with additional paper offers during the up move, suppress the momentum, and hope to repurchase lower later. The issue arises when everyone follows that same strategy. The market anticipates the play before it's fully executed. In only a few trading days, reports circulated of massive added short interest. Figures around more than 25 million ounces piled on in roughly 48 hours, translating to thousands of futures positions layered in. If accurate, even approximately, that's not cautious positioning, it's overconfidence. Overconfidence succeeds until it suddenly fails. To be balanced, the online space often oversimplifies. Not every short position is malicious. Certain ones serve as legitimate hedges. Others are spread positions or liquidity provision. Still, the combined effect at critical junctures produces the identical result. Paper offers overwhelmed buying interest to choke the advance. So the real issue isn't whether shorts are bad actors. It's how many ounces are committed on paper compared to how many physical ounces are actually deliverable if someone demands the real thing. That's where the stockpile reality becomes critical. Now let's examine the warehouse figures, since this topic sparks endless debate, and most people get it wrong. COMEX silver stocks aren't a single stack. They're divided into segments. Eligible means the bars meet standards and are stored in approved facilities, but they might not be offered for sale. Registered refers to the portion designated for potential delivery on futures obligations, the metal that counts when actual takeouts increase. That's why registered matters most to me. Here's the stat that demands attention. Registered inventory has hovered near 116.0 million ounces. Absorb that. A marketplace, handling enormous paper volumes, has a deliverable pool only in the low hundreds of millions. And that pool can vanish rapidly once outflows accelerate. Even if 116 million ounces seems substantial, consider two realities. First, futures turnover doesn't equal physical movement. It reflects bets, protections, gambles, arbitrages, and position carries. One physical ounce can underpin countless paper transactions without ever shifting. Second, silver functions beyond a mere precious holding. It's an industrial essential. Industrial consumption ignores hype. That dual role defines the entire dynamic. Silver occupies a unique spot. Gold doesn't. Gold functions mostly as a financial and reserve asset. Silver carries monetary appeal too, but it's deeply embedded in practical use. Electronics, photovoltaics, healthcare, catalysts, anything requiring strong electrical flow. As global electrification accelerates, silver receives steady votes through real-world needs. And recent developments matter here. The exchange has responded to heightened interest. A fresh 100-ounce silver futures contract was revealed, aimed at expanding entry and accommodating robust retail involvement. That's a meaningful indicator. When an exchange introduces smaller contract variants to handle demand, it signals participation is growing broader. Wider involvement can fuel momentum. It can also introduce vulnerability. Since larger crowds increase the odds, someone will eventually demand something beyond perpetual rolling. As for current pricing, silver futures have traded in the high 90s per ounce. We're past the old $20 era. This is a market that's already adjusted significantly. That's precisely why the upcoming stage feels risky. The stage where peak calls echo daily. The stage where shorts convince themselves the advance is spent. But markets don't peak purely from elevated levels. They peak when momentum shifts. They peak when new buyers fade and sellers dominate. They peak when the narrative stops attracting fresh funds. What could flip the dynamic in silver? Two primary factors: weakened industrial appetite or fading investment interest. Industrial appetite isn't theoretical now. Photovoltaics represent a huge slice of demand. Manufacturers have cut silver usage per unit over time, but deployment volumes keep expanding. Advanced cell tech often resists further cuts in conductive materials. Efficiency gains have limits, so thrift occurs, yet growth counters it. That's the ongoing struggle. Broadly, even conventional reports acknowledge ongoing supply shortfalls in recent periods. That doesn't spell instant depletion. It means surface stocks act as the cushion. Cushions erode. Numbers can be contested. Direction matters more. A shortfall is arithmetic, not sentiment. Now, addressing a frequent claim in silver communities, annual consumption exceeds new mining output, and that alone will shatter the paper structure. It could, but it might unfold differently than expected. Supply isn't limited to fresh production. It's production plus recovered material plus existing stocks plus alternatives. Demand extends beyond industry. Industry plus adornment plus bullion plus funds plus private accumulation. Here I offer a contrarian angle for balance. Listening to only one viewpoint makes you foreseeable, and markets exploit predictability. Certain observers contend the standard story is overstated. That contract positioning gets misinterpreted frequently, and if genuine physical shortage existed, you'd rarely see some physical products lingering below their asset value for extended stretches. I'm not claiming that's entirely accurate. It's a bracing reality check. It pushes the question: what constitutes undeniable evidence of a real squeeze? What signs appear in differentials, takeout requests, markups, or vault movements? That returns us to essentials. Metal movement over internet buzz. Reports highlight swift COMEX drawdowns, tens of millions of ounces exiting in brief January periods. Even as isolated events, they signal something important. Accelerating takeouts shift focus from news to vaults. So keep this first key question in mind. If another strong price leg occurs with registered already constrained, does it trigger more physical requests? Or does added paper simply halt it? The winner dictates everything. I anticipate the replies already. John, this is the breaking point. The system might collapse here, but I don't peddle dream schedules. I map hazards. The future's setup endures because most players seek exposure, not possession. They pursue directional wagers, protections, arbitrages, or carries. While this majority views silver as screen digits, the framework can extend beyond physical logic. But when a notable minority insists on actual delivery, shorts feel the heat. A short isn't merely speculation, it's an obligation to supply or exit. Both become costly against adverse moves in thin conditions. Here's a harsh truth. Stubbornness hurts worst precisely when the herd turns liquid. Shorts need counterparties to appear, or exchange intervention via higher margins, circuit breakers, or structural changes. It sometimes stabilizes. It sometimes delays. Delay fails if metal keeps exiting. Revisiting registered versus eligible, many misunderstand it. Eligible can shift to registered if owners opt in, but eligible can also depart, taken out, relocated, collateralized differently, or locked tighter amid perceived tightness. Eligible represents potential, not certainty. Potential activates only by choice. That creates the second key question. As prices rise and broader awareness grows, do eligible holders dump into rallies, or do they cling, betting bigger gains lie ahead? That's behavioral, not chart-based. Now for the uneasy topic, story battles. Silver rallies spawn two extreme content types. One claims it's the ultimate controlled market, collapsing imminently. The other insists it's meaningless fluctuation, and believers are misled. Both can miss short-term while eventually aligning long-term. Control can persist without a fixed expiration, and tightness can build without instant crisis. Avoid fixation on poles, concentrate on trackable stress zones. Stress zone 1, trend velocity, gradual climbs differ from steep ascents. Steep ones provoke margin adjustments. Stress zone 2, stock trends, particularly registered. We have 116.0 million ounces concrete. Stress zone 3, new tools and crowd signals. The new 100-ounce contract announcement reflects retail strength. Stress zone 4, industrial backdrop. Solar, tech, and green shifts endure regardless of chart heat. Add plumbing signals few mention during rallies. Implied volatility prices, doubt. Margins rise with explosions, potentially stalling or dipping moves. Margins steer. Explosive advances sometimes stall abruptly, not always conspiracy, often forced deleveraging. Right calls can still lose on poor sizing amid volatility shifts. On stocks, ignore single-frame panic about imminent zero. Track direction. Registered has plunged over years. Total COMEX has retreated from highs too. Constrained isn't depleted. Constrained signals eroding safety margin. Zoom to industrial core, the multi-year play. Solar thrift has slowed, easy cuts exhausted. If If thrift plateaus while builds accelerate, supply must come from somewhere. Mining expands gradually, recovery slowly, stocks absorb shocks. Answering a common query, if tightness exists, why doesn't paper just flood contracts indefinitely? Paper flexes, but sustained outflows raise costs, especially if players shift from paper bets to owned metal. The real danger isn't one headline failure, it's gradual trust erosion. More choosing physical custody as ultimate protection. That's the watch point. What if no dramatic one-day event, but steady physical migration to private vaults, leaving paper claims on dwindling availability? Violent spikes could still occur, yet the underlying direction persists. Another key signal, the futures curve. Front-month premiums over deferred indicate urgency for now. Sometimes true shortage, sometimes funding stress. Either alters actions, encouraging vault withdrawals over reporting. Debate intensifies here. Skeptics say tightness claims recycle cyclically. Shorts misunderstood. True corner would show uniformly in premiums, chart funds. Balance both views. Practical test, price surge with stable premiums, or more likely paper noise. Surge plus wider premiums, longer waits, or genuine constraint. Surge plus draining stocks, or current collision point. Exchanges react then. Margins, adjustments, new vehicles. We've seen smaller contracts to redirect flow. They don't produce metal. They offer more betting avenues. They might diffuse speculation or draw bigger crowds. Setup, diminishing cushions, rising crowds, industrial indifference to stories. That's why vigilance matters. If mainstream dubs silver the year's winner, does access expand or clog? Back to broader view. Before continuing, share your market wins, silver or elsewhere, in comments. Not boasting, encouraging those quietly studying that steady effort rewards. Now shifting wider. Cycles hide deeper drivers mainstream skips. One is monetary metal interplay. Ratios get treated as iron rules. History doesn't bind. Ratios reflect sentiment, flow, confidence. They vary with conditions. Yet ratios highlight mispricings. For silver to dramatically outpace gold, gold needs uncertainty premium. Silver needs uncertainty plus manufacturing pull. Counter, severe slowdown weakens silver's factory demand even as monetary rises. Silver can trail gold in downturn fears. Bull case for silver isn't linear. It's monetary versus cyclical tug of war. Timing decides. Now, something eyebrow-raising. Data glitches. Pages lag or fail during peaks. Calm markets ignore delays. Hot markets turn glitches into plots. My view, often technical. Overload, traffic. Sometimes, yes, transparency stress when crowds seek truth simultaneously. Opacity breeds suspicion, accelerating fear. Here's an unexpected angle. Digital backbone. While bars dominate talk, parallel narrative involves data distribution, network resilience under load, exchanges adapt via new tools, access, non-physical trades. Trend widespread. Past physical-digital clashes highlight diversifying beyond metals into systems handling information compute when centralized points strain. No token pitch here. Point, disrupted chains, chips networks, favor assets avoiding single failure points, includes silver, includes network infrastructure, ties to breakage scenarios. Geopolitical hits cause repricing in energy, metals, costs, risk premiums. Why higher silver? Layered forces, crowds, stocks, shortfalls, global shocks. Clear note, premium member content exists, deeper dives, cleaner production. For those wanting substance minus clutter. Back to metal. Emotional error. Expecting markets to deliver tidy results. Buyers await explosions, shorts await drops. Markets indifferent. Incentives clash. Industrials seek calm supply, which hour pricing, detest swings. Speculators thrive on swings. Institutions monetize volume. Authorities prioritize currency, trust, stability. Silver caught in crossfire. Explains oddity. Informs positioning. Plan hinging on imminent break. Brittle. Plan owning asset for long policy industrial trends. Durable. Third key question, what if no system fracture this year, yet silver leads hard assets next cycle via steady climb amid electrification? Needs endurance, not drama. Expanding crowds hint at that path. Now targets. Everyone craves numbers. 100, 200, 1,000? Target simple, execution tough. From high 90s, $100, psychological war zone, magnet, clean break sparks headlines. Rejection triggers shakeout, scares weak, rewards strong. Watch boundary behavior, consolidation or spike, reversal, pullbacks, normal breathing. Global angle, demand beyond West. Volatile currency regions view metals differently. Globalized demand ends niche status. Newcomers. Registered isn't sole gauge. Ecosystem counts. Refining, scrap, mint output. Lead times, physical premiums. Futures, high 90s. Physical often higher amid bottlenecks. Disconnects grow in stress. Track premiums, weights, dealer speed. Share your premium, dealer, entry wins, and comments. Motivates others. Quiet successes, loud forecasts. Near end, discipline versus thrill. Imagine two paths. Path 1, paper endures, rolls continue, stocks vary, liquid market. Silver grinds higher in waves, not blasts. Patience triumphs, leverage suffers. Path 2, delivery surges, registered squeezes, scarcity priced aggressively, volatility brutal, weak exit. Both start same, prepare for either. How? Position responsibly, horizon clear, no margin chasing, track catalysts, policy, industry, stocks. Exchange adapts, new 100 Oz contract channels demand. Relieves or inflames, depends on sentiment. Fourth key question, do new tools calm by dispersing or ignite by crowding entry? To rigged believers, respectfully, repeated smashes, odd liquidity fuel suspicion, sometimes valid. Yet physical limits persist, price distortion possible long-term, atoms not creatable. Story, flexible paper versus rigid physical, collision or volatility. Wrap, know your why for owning trading. New, excitement plan, sidelines, avoid waiting for universal chatter. Entries harden then. Markets punish late conviction. My question. Next silver driver, industrial crunch, monetary fear, or paper collapse. Comment time watch 2. I read them. Shows reach, chart spread. Stay safe, support each other, keep discipline amid noise. Nothing here is advice. Opinions, Josh info for education. Research, assess risk yourself.